we'll start off with a little introduction to kind of a dictionary terms of what supply chain management is and how it relates to inventory control. And today, our core feature that we'll discuss is inventory control and 5 key steps around it. And once we get into the 5 key steps, I'll show you a little bit of definition as to why that area is important to manage, and then some tips and techniques in the tool set that we have at INDUSTRIOS to help people along. We'll then close off by looking at some success stories that INDUSTRIOS has had over the years, specifically in this area, and some of the positive gains that you can realize when you focus on and take advantage of the tools and techniques in the ERP system to work you towards better supply chain management inventory control. So to start, let's talk about inventory as part of that supply chain management process and system. So for everybody, supply chain management, really you're talking about synchronizing everything that has to do with getting the raw materials. I mean, some people will talk about getting the raw materials right out of the ground, all the way to placing your finished goods at those locations that your customers need them and when they need them. So from a system point of view, you're talking about your vendors at one end, your customers at the other end, and all of the processes it takes to manage moving the goods back and forth through logistics, maybe your distribution network, where your warehouses are located, scheduling techniques. And at the core of it, we have this thing called inventory. And inventory from a system point of view, helps us track what we own, where it actually is, and what it costs. So for today, we'll focus on inventory and these areas of operational control that inventory affects. There's 2 main ones that we'll look at. One is the management of the inventory itself as part of the supply chain. So the quantity of the items, where they happen to be, and regardless of the form of that item, we need to track as manufacturers. We need to track not only the incoming goods, we need to track the goods while they're in our hands and being converted into assemblies and sub-assemblies, and then finally into finished goods and moved on to our final customer destination. All along that flow and that track, there has been cash required and cash needed to pay for the downstream goods and hopefully receive money from the upstream people that are using it. And knowing what our costs are at all the different points in time and where those dollars are being applied and associated is a key part of supply chain management, so that we can really get to a point of synchronizing our payments all the way across that supply chain. There are 2 main, as we found in our experience, 2 main views of inventory. One we'll look at is the accounting view, and then we'll take a look at more of the operations or ERP-centric view. And accounting systems, because they were obviously built from the ground up in terms of financial reporting, kind of view inventory as a number, as a result. At the end of the day, the financial reports need to get done for banking purposes or whatever, and you need to know what your inventory is, and raw materials, finished goods, and work in process. At the end of the year, you're probably having your auditors come in and run some type of physical count to, again, verify, for the most part, verify that you have what you say you have. The question about how you got it there and were you managing it effectively really doesn't come into the picture. So the accounting system view of inventory really is primarily used for reporting. And the example there we have on the screen, it's fairly basic. You have 7 parts in a location, you paid an amount of dollars for it, so really that's what you have in your valuation. The level of the cost that you track towards those items is fairly flat. For the most part, in a distribution type model, you have a purchase order and you have a sales order at the other end. So it doesn't really get to the core and get to the point of what the whole complexity around supply chain could be. And from an accounting point of view, I don't blame them. I mean, I'm married to an accountant, so I understand how she looks at these things. And I don't blame them for not really wanting to look at the whole cause and effect and downstream and upstream, because really that's why they hire other people to be looking at their operations. I call it the driver for their view of inventory is to get something for my books, just get me a number, and we'll be able to be happy moving forward. The operations system takes a much more complex view of inventory, or towards inventory. Really here we're looking at the processes required to manage two streams or two tracks of that inventory. One is the quantity track and the other one is the dollars track. So on the quantity track, we really need to know when do we need things, why do we need things, and how are we going to use those elements as we try to keep our customers happy. ERP systems that grew out of the accounting systems then bring to the table functionality at a low level. Some examples might be sales order kitting, multi-bin tracking, and cost elements. The sales order kitting is just a way of recognizing that everything included or that given an item number doesn't always have to exist in inventory as a physical element. You can have inventory that's there for usage in terms of selling, but not actually for tracking. The data that we're actually tracking when we are in the operations side of inventory is not only used to support the valuation requirements that our accountants or our finance team has, but we also need it to support this management of our supply chain. So we want to know things such as, did the vendor supply things on time? Was it in the right form? Did it come at the right cost? Were the right elements to those costs associated with it? Were they delivered to the right warehouse, and was our flow time within the warehouse proper? Did we receive it properly? And a myriad of other sub-processes that really need to be managed properly and well to be able to know if you have the right inventory at the right time. In the operations side, you're going to rely on lots of techniques out there, from basic MRP to visual systems, just-in-time, synchronized manufacturing. There's many different techniques out there, and you want a business system that can support those. One of the key things that we found in our implementations is that the definition of an item master kind of gets lost in the shuffle. An item master generally comes from an accounting list because there's classification required for valuation purposes. But on the operations side, really the item master has to be owned by multiple people. Has to be owned by finance, which is fine. They have to own their information. Procurement has to own their information. Sales has to own theirs. Engineering and production have to own theirs. And each one of those subsets might have different requirements for reporting or analysis. The driver that I call here is you need to know that you have the right things at the right place, at the right time, at the right cost. It's basically give me everything that I want. And from a customer's point of view, you want to satisfy your customer fully and completely. So let's talk about 5 steps and 5 areas that you can utilize within an ERP system to gain better control and more effective supply chain management. We'll talk about material planning, physical account processing, some things around costing and standard costs, and then 2 analysis tools primarily on purchasing and inventory. Material planning, the core of any inventory control system. What you're seeing here on the right-hand side, and you will as we go through the presentation, are just some screenshots from the INDUSTRIOS system, so I can point to a couple of key elements that you should be looking for and looking towards in your systems. Really the MRP, or the material planning engine at the core of your system, is really trying to net that supply and demand. And how you define your demand and how you define your supply and all of the criteria associated with them will affect the presentation on a screen such as the one that you're looking at. The location of the material from an inventory point of view is not necessarily how you plan it from a distribution point of view. You can have multiple warehouses or multiple distribution points or even multiple areas within your warehouse that you want to plan together from a material point of view, but report on separately from a valuation point of view. So you need to make sure, you want to know that your system can support those different techniques. As you look on this screen, you have columns that will associate information which is critical from a material planning point of view. A bucketing generally is a place that you will have date sensitive because you want to make sure that a material plan is time phased or in date order. You want to know what you have today, what you don't have today based because it's late, and what you need tomorrow in terms of supply and demand, so you can net out those requirements and have the system generate actions for you. Different types of demand that you see presented here. You have preliminary demand, so it's kind of demand that you have coming in that it could be in a state that has not been confirmed by the customer, firm demand, and then your forecast either on the demand or supply side all needs to come in here, and different people who own the information have to have good hygiene to be able to make sure that their information is correct, so when it gets to a system like this, you're looking at reasonable information. And that could be that the forecast is correct, dates are being managed properly, the right dates are being defined, stocking constraints in terms of minimums and maximums and reorder points are being handled and managed at each of those different locations to be able to give a good picture and give your procurement staff and your production staff a fighting chance to get to the next level. So just implementing a material planning module without having all of those key sub-information areas defined, prepared, and managed, what you're going to get out of it is not going to be very, very clear. Once you do have it nicely well managed and well under control, you then look to a system to give you actions. The standard INDUSTRIOS action report is being displayed here, and really what you're trying to do is isolate those situations that you need to do something about. In the middle here we have a bunch of items where you have supply coming in, but you don't have any demand. And the demand could have dropped off because the customer canceled it, the forecast was incorrect, sales was incorrect in putting something in. It really doesn't matter what the reasons are, but from a procurement point of view, you want to make sure you get that supply out of there so that you don't have too much inventory. You then need to use this as a trigger to really either question what the internal processes are to get you to the point where you had supply without demand, and possibly some continuous improvements to better manage the spread between the supply and the demand. Other types of exceptions, such as what's happening in terms of things that are too early or too late, are also indicative of either bad planning underlying it or changing requirements. And there's to be open, telling you what's actually happening, and putting the tools in your hands to be able to properly act on what you want to buy and when you want to buy it. The other element within material planning and the action report specifically is that the key steps is that you need to have a good understanding of your internal processes and your internal process times. If you are buying goods from overseas, for example, there are elements of the purchasing planning cycle, the logistics cycle in terms of getting things loaded into a container, delivered to a dock, on the boat, on the sea, to your receiving location in your port of origin or port of destination, and then getting the goods from that port to your warehouse. And it doesn't end there. When it gets to your warehouse, you need to inspect those goods and put them into your bins or racks. A good understanding of all of those different times will give you the ability to feed the material planning engine with better assumptions to give you much better information back. So at the end of the day, when we're talking about inventory and supply chain, the material planning core is what you're going to use, or what you can use, to really give you the information that you need to make sure that you're buying the right things or making the right things at the right time. Now that we have all these goods in our warehouses, or we have them physically, we'll talk about counting them and making sure we know how many there are. And I'm going to immediately move away from this concept of physical count, and we'll talk about cycle counting. Really, in good supply chain management, from an operations point of view, you want to look at really the processes that it takes to have inventory rather than the end result. So the physical count at the end of the year to support your financial report is a valid reason to count things, but from an operations point of view really doesn't support the needs that we have. our experience and our recommendations is to, as much as possible, move to cycle counting, where you're really looking at different reasons as to why you may count them. You may spawn cycle counts every week of just those items that it says you have negative inventory, and you want to highlight what drove the negative inventory status in your system. That by itself, having negative inventory, could possibly cause a ripple effect both downstream and upstream. From an inventory point of view, you're counting it correctly, but either the timing of your processes or your timing of your transactions hasn't been supported. So the move to a cycle count and moving towards that really allows you to spread the pain over a particular period of time and focus on those areas that really need the most attention. It could be your high-moving items, your high-value items, potentially items that have shelf life. You want to have tools differentiate among all of your inventory that you have in your item master list and decide which ones you want to count and how. And moreover, you want to get into a process where you don't need to basically stop all of your operations just to count inventory. Cycle counting should be a fairly simple, benign, straightforward process where you are launching your count sheets or your tags or downloading to mobile managers, counting the items, verifying and looking at the impact and sending it back so that you can really get trust in what your inventory says. At the end of the year, it should not be an issue to demonstrate to your, if you have third-party auditors or accountants coming in, to show them your cycle counting process and have them sign off that it's a true and valid representation of what you have in stock. The actual count mechanisms itself, what some of the things to look for in a good system that will support you, again, is to be able to filter or range on your entire list and only send out to the floor, either by area, zone, rack, warehouse, whatever it happens to be, just those items that you want to look at and want to count. That count should happen either through a physical tag process or an automated handheld. Either way, you want things to be simple, clear, and easy to do from a user's point of view. Invariably, one of the things in counts that kind of hold things up is when either tags are mismatched or you're getting discrepant counts. So the ability to stop, automate, and track the recounts is a real key driver in allowing this process to go through quickly. And one of the things that we like to do as part of all of our physical and cycle counts is that we're constantly giving you online visibility into the impact of the dollars prior to posting. And we find that an invaluable tool from an operations point of view to understand as they're going through the impact that they're having on finance, and secondly, to give the finance team a heads up as to what's happening rather than just taking an end-of-year, oh my gosh type approach and look at what's happened and try to, like Sherlock Holmes, go back and figure out what could have happened over the last 12 months. So from a physical point of view, the two areas that we talked about, internally for a inventory control in terms of material planning and physical count, those two are the key areas that you should focus on. Material planning from what do I need to buy, when do I need to buy it, make sure it's here on time, and the physical count is the one that will allow you to measure and through cycle counting have good trust that the numbers that you have physically on hand are the ones that you can use properly to make your decisions. As we move forward, the next two areas that we'll talk about are kind of analysis and after the fact research, where you're mining your data for information. So the static view of inventory that says I have 55 is really nice, but you want to be able to support good supply chain conversations, to be able to, either on the raw material side for your vendors or on your finished goods side for your sales staff or your distribution network, to be able to give them good feedback as to what happened internally with your inventory. So what we've done in INDUSTRIOS is we've taken that physical count approach where you're taking a snapshot of your information and you are acting on that. On a physical count, you'll act on it by entering in the quantities that you actually have and posting all the transactions. On the inventory analysis, what we do is we give you the tools to do period analysis, period snapshots of your inventory. And we're going to look at, if you look on the screen, you have your on-hand numbers, what the average over that period was, possibly your current minimum stock, and the system then has the ability to then calculate for you suggestions to be able to have support for the demand that you have. What is your calculated minimum stock? And how does that translate into inventory turns, based either compared against the target that you may or may have, or if you want to start developing targets for inventory turns on an item-by-item basis, tools and techniques like this can be used so that you are able to, over enough time when you're interacting with your inventory, you can take a look at last summer versus this summer, last winter versus last summer, and you can start to identify trends. You can possibly support the seasonality that might be present in your business. And what the tool here allows you to do is it gives you functions and abilities to automatically and easily change those stocking constraints. So through a set of techniques similar to physical count, where you are taking your snapshot, looking at the analysis, making your changes, and then posting those changes, analysis tools in inventory like this allow you to automate the process of changing constraints such as minimum stock, reorder quantity, inventory turn targets, and have a batch of transactions so you can easily switch over from winter to summer mode, or from last year to this year, or if you're given through your business planning process where you're given that you expect business to go up or down a certain percentage, you can look at your key items and manage those stocking criteria fairly quickly. The interaction with the item master here becomes critical because the classification that you have in terms of what your item number is called or your SKU is called, what product category it fits into, what type of item it happens to be, raw or finished, allow you to quickly drill towards only those items that you need to see, or maybe that you need to manage. If you have distributed planners throughout your business where different planners can manage a subset of inventory, then you can use those fields and that information in the system to have everybody generate their own analysis as they go through. The end result of good analysis is good output, and here's an example of a couple of things you really, really want to see is the trend type analysis, as well as snapshot types where you're looking at slow moving versus excess inventory. And here, when you're looking at your inventory, if you've done your material planning correctly and you've counted it correctly, you're looking to highlight those things or those items where possibly something has changed. Either they're not selling fast enough because our mix or product mix or ratio of sales didn't happen, or you have excess possibly because engineering has made a change and you haven't run down the old inventory fast enough and you end up with excess inventory. The report analysis tools that you want to do, if you're going to mine it inside or even outside of your inventory system, is you have to recognize that these are not static snapshots. The fact that you have too much inventory today may not recognize that you have a large job or a large customer order coming in the next few weeks. So the technique of using the analysis tool that we have and properly doing the snapshots allows you to define what kind of consumption you want to actually include within your excess, in this case, excess inventory analysis report. So this consumption could include future consumption, and that is driven from sales orders or bills of material and the dates that go with those sales orders and those bills of material to give you the right information in terms of what is truly on hand. And here you see we have the report. It's on hand in excess of pending sales and consumptive transactions. So not only is it a static snapshot of what's happening within the system, but it gives you a little view into, is it critical to work on right now, or should you just keep your eye on it to make sure that that future consumption actually happens. These are the tools that you can then use to go back to your internal planning and procurement group to have them not only work with your internal warehousing team, but possibly with your vendors or your sales staff to understand and better decide what the actions or the criteria you can use to whittle down the excess inventory or get rid of that slow moving. The next analysis type that we'll flow into is now we're bridging the supply chain requirement of inventory from a quantity and a cost point of view. So sometimes supply chain decisions are driven based on dollars. You could have the onshore or the nearshore solution versus the offshore solution, and you want to put tools into the hands of your inventory or your procurement staff to be able to measure how you're doing in terms of on-hand quantities and dollars spent and where your cash is being used, but also to trigger some vendor tools to be able to properly compare what it takes to buy, in this case we'll talk about raw materials, what it takes to buy raw materials from different vendors. As a valuation technique, you may have selected standard cost as your valuation technique, and that brings with it a lot of analysis that comes with the variations that happen. But you want the variations, if possible, to happen at the granular level rather than the gross level. The fact that you make a standard of $150 might mean that you're absorbing certain costs that you're predicting are going to happen within that standard cost. And depending on which vendor you may use, some vendors are close and fast and some are far and a little bit slower, the variation you're going to drive towards purchase price will bubble to the top. And what you really want to do is highlight those areas where you're potentially having significant variation, and that could highlight or that could indicate that there's a potential supply chain issue. Not even a problem in the supply chain itself, but in how we're managing the supply chain. Typically, what you'll find the answer here is that we've had to run a bunch of expedite charges or overtime charges or rush charges to be able to get to the stock to our warehouse in time, because we haven't been able to properly nail down our internal processes to ensure that we have the right demand coming through the material planning engine. So if your bills of material are not stable, if your vendor reporting back is not stable, if your sales reporting in is not stable, all of that could potentially lead to significant variation within purchase price. And that becomes an indicator something's going on. Some of the information that we flow back in terms of this screen, over the period that we're looking at, and again the period might have been last year, last month, however you want to make the snapshot, we have the lowest cost for the period, a highest cost, the mean, so you know where the middle is, and then the last cost in terms of where it actually came in, so you know where you are now. So you might want to highlight that highest cost and send that back to your procurement team and say, what happened here? Let's do a root cause as to what happened to drive that $30 purchase when normally we buy things for about $7. So, or $8 or $9. And that could end up being, well, we made a last minute bill of material change because the customer changed their mind, and then sales never actually really flowed that change through, or we improperly scheduled it, or we didn't have enough on hand. Whatever the reason is, it doesn't, at this point doesn't matter. What you want is a set of tools and techniques to highlight that those things are happening or potentially happening. Talked earlier about if you're using target costing or standard costing, within within the standard cost, what you have is, we'll go back to what we call cost elements. And a cost element in, if you're in the U.S. and you're buying from overseas, some of the cost elements you might include in your standard cost are prediction on foreign exchange. You might have freight, duty, and brokerage costs, material handling, and logistics. Different places that you're going to receive after the fact invoices to compare against against your embedded standard. So this really here is a bridge between what's happening on that accounting view of inventory and the operations view of inventory. What you want is you want them to each have all the information that they need to be able to go ahead and do their job. So if we have an item that standard cost is $150 and it drives its variation because we bought it at $138, that's fine. That $12 positive variance comes to you and it's accounted for, and that's fine. What we want to know is what was the driver for that variation. So if the $150 standard is made up of something like $120 of material cost plus $30 of freight, duty, and brokerage, we want to measure purchasing first off on what was the negotiated price for that item. If the PO went out the door at $122, $2 on the negative side of that variance was generated from the purchase. Then we had to expedite charges. Instead of bringing it by container and boat, we had to fly it over, and there were invoices that were more than we were expecting to drive that variance. We want to know that, both from a procurement and operations side as well as from an accounting side. The last thing from this analysis tool, we talked about being able to update. Having offline techniques like this to actually make changes to your standard costs and then roll those standard costs up through your make items, through your bills of material to get rolled up new costs is a very valuable and useful tool. An example in our customer set where we had a customer that would take upwards of a week to analyze and do manual roll-ups by printing out the bill of material and recosting those bills of material and changing the inventory prices. They've been able to get down to this process being, if they really push it, it's half a day. They could probably get it done in a couple of hours. And that's because they have a really good understanding of where those cost elements are driven from, why they're coming there, why we want to make the changes, and to have the authority then to drive those changes through. So let's get into depth about this standard cost, and here's exactly why that purchase price and standard cost dovetailed together. The screen that we're looking at is one of the definition screens that INDUSTRIOS has in terms of being able to define the areas that we've talked about. So from a purchase price analysis, we are identifying those items that have variation in costs, and here we're now talking about why those variations are happening. Now, if you're sitting there and you're not a standard cost shop, that's okay. You can be using target costing, and it could be FIFO or weighted average. And what these elements allow you to do is to have added costs into your inventory above and beyond your purchase price that you can then measure. So in a standard cost, those elements are embedded in the cost that you have in inventory. In target costing, what you're doing is you're purchasing the goods at $120, which is fine. Your AP voucher will get created at $120 for that vendor. But then we will, or the system will, apply a percentage of the purchase price, in this case 5%, another percentage of the purchase price, another 12%, and then 1138 straight dollars to the value of the inventory going into stock. So in this case, the 120 would go in at about $135 or $140. It's decoupled from accounting, and it's decoupled from operations. Now, your procurement group with finance can decide what those accumulators happen to be in terms of where they want to manage the exchange rate or the foreign currency, the freight, and the handling. And internally you're using the items at the real cost, which gives you now good tools to make sure that you are recognizing the true cost of buying things from different customers or different vendors, sorry. The cost of nearshoring something and the time that it takes versus the cost of offshoring or having different vendors in different areas of the country can then be highlighted, and you're giving your procurement staff through tools like this very good techniques to have excellent conversations with those vendors to make sure you're using the right people in the right areas of the supply chain. And here's an example of a report where we're giving the procurement staff an idea of what it took to buy it in the first column of material cost, and then all of the, if this is standard cost items, all of the embedded costs that were implied by buying it from these different vendors, the freight, the handling, the surcharge, and whatever happens to be. So here, the inventory processes are not affected by the accounting analysis, but in the opposite, they're actually driving that information needed to either be done by an analyst in the finance group or in the procurement team or the purchasing person. So what you want your people to do is to buy what they need to make sure they get it when they need it, and recognize that there are differences in the costs of doing business with different vendors to be able to support your internal needs. So if you implement a system and you put the techniques together, I mean these among more, but if we highlight these 5 techniques within your inventory system, you should be able to drive good results. I'll give you 3 examples here. This first one, so we have a local here too, and we're located just outside of Toronto in Canada. We have a local manufacturer. It's a large $100 million or so manufacturer of point-of-sale type furniture. And their experience before implementing proper control processes around inventory in their supply chain is that they were having a lot of difficulties with their vendors. Their vendors were effectively telling them that they were driving the vendors nuts, that hourly changes, phoning us every day, changing your mind, I forgot to buy this, I didn't buy that, I don't want 20, I want 36. They were constantly firefighting and expediting, and the vendors weren't very happy. You know, the volume of business was nice, so they kind of put up with it, but you know, if given the chance, they would stick it to them with expediting charges or overtime if they could. Move forward in time, and after a fairly lengthy process to implement good hygiene around inventory and really trusting the numbers, core of material planning was really effectively used and split up among the team internally. When asked, the vendors definitely recognize that they're now more effective. The vendors are now happy to work with them, and what it's resulted with is fairly significant dollar, we'll call them savings now, but they're dollar differences to the positive that the improved vendor relationship had. So they've been able to, because now they trust what the customer is giving them in terms of what raw materials are to be supplied, they're in a much better position to leverage that relationship when negotiating those purchase contracts. And they've been able to move to not so much just in time, but to a longer purchase view of giving their supply chain really good visibility. And not only is the visibility good, but it's firm. And by that, I mean that they're not waffling and there's no toilet seat action happening where the changes are happening. The changes might be happening in the far future, but in the near future, within the supply horizon, the requirements and the data is fairly static and trustable. Second example here, they really focused on implementing the analysis tools that I showed. The inventory analysis specifically around excess inventory. They have an issue about not so much seasonality, but the time sensitivity and the expiration of the goods in stock. So they have to be able to move things fairly quickly and make sure that they're making things in small enough batches that they don't stand in stock for a long time, because otherwise they become obsolete. And on the opposite side, when they were buying, they wanted to shift back to kind of nearshore rather than using Pacific Rim vendors. They wanted to use Central American vendors, and they wanted to get a better handle on those internal costs so that they could better manage those vendors. And the result that they have are fairly good in terms of their obsolete inventory went down 75%, and they improved just because of that, because of the batch sizes going down. They improved their turns in their inventory by almost 60%. So just by having better information, the timeliness of the information being more correct, they were able to flow things through their not only production process faster, but their warehouse faster to get significant success. And the last story, I'll start off with that nice little quote that they gave us, and I love the word absolute. I mean, from an inventory point of view, from being an engineer, I appreciate what that means. And here, obviously, he feels that he's really got a handle, or they really have a handle on what's going on. They implemented a bunch of techniques and a bunch of different tools within their supply chain, but their inventory was really the key. And this is a fantastic example of what the difference of moving from physical count to weekly cycle counts drove for them. Not only the physical count savings and having their auditors come in to verify information, I mean, that savings was just there, but the write-ups and write-downs through the inventory was down, let's call it a lot. It's a fairly large company, and it went down quite a bit. And because they had tighter control and better hygiene on their inventory, they were able to sell things faster, to tell their customers they had the right things at the right time, and they were able to buy their raw materials better because they knew what the customers wanted. And point number 4 can translate to a significant dollar savings. 29 production days, if you have even only one person working at $20 an hour, is a good chunk of money. If they're actually stopping the whole factory for the equivalent of 29 days to be able to do the count, then the savings become astronomical. So these are, I would call these typical, not extreme, results that you can find by flipping from that view of the item master being an accounting function and inventory being a number, to inventory being a result of a number of different processes and everybody owning their own slice and being accountable for their own slice of that inventory. And if you look at the different people that touch that inventory, it's accounting, production, engineering, warehousing, sales, purchasing. Each have something to gain by ensuring that their elements and their information within that item master is properly defined. So with that, let me close off by giving you a little bit about INDUSTRIOS and about why we do the things that we do. We've been around since the late 80s in this form. We only work with discrete manufacturers and distributors. And really what we've tried to do is provide a set of tools that simplify, or maybe that address those complex issues within business. So we try to simplify things such as updating standard costing or the different techniques that we talked about today. We work with the suite of Sage ERP products, and have had really good success being a Sage partner over the years. In the distribution environment, we'll talk about functionality, whether we can look at functionality from an ERP side, that process-centric side of inventory, in terms of management of sales and shipping planning, consolidating shipments, automating bills of lading, having integration into third-party shipping tools, internal multi-bin tracking, a lot of different tools that distributors could use to start to granularize what inventory they have, why they have the inventory, and where it happens to be, and automating and making it quick to get out the door. On the manufacturing side, in the discrete world, the tools that we have work very well in the make-to-stock world. So we have, forecasting, the ability to import your forecast as part of the material plan and have all the tools and techniques around stocking constraints and criteria. But our real focus over the years has been on the to-order market, where things are changing. The bills of material, the engineered bills, the configured bills, or the routings, or the projects that happen to be going through the shop floor, and then having all the tools and techniques to manage the supply chain from that whole vendor network all the way through the distribution and customer network out the back door. The types of industries, just an example, from teddy bears to prisonware, which, I always ask marketing why they put those two things together, but they seem to think that they're related, all the way down through, fairly large, heavy industrial equipment, projects that take 7-8 months before the bill of material is actually finished. And by the time the bill of material is finished, so is the product, and it goes out the door. So the long lead time and in-transit management of raw material coming in through the supply chain is critical there, because you're actually developing the criteria to drive that demand on the fly. So in summary, I'd like to leave you with 4 thoughts. First of all is, in any ERP implementation, you really need to respect the data, and you need to know why information is being put into particular fields, where it's coming from, and who needs to use it. Specifically when it comes to inventory control, the separation of the dollar side and the classification and usage side is critical, and having each of those functional areas or people or whatever hat they're wearing at the time know that information can only help later on. Recognize that inventory for operations is a process or a group of processes, and it's really the flow of those processes and getting them into control is critical. Inventory for accounting, which is just as important, it's a result and it's a number that is used for reporting, which is fantastic, but we want to make sure that we focus on those processes. You can, in your supply chain, really use effective inventory control. The number one, or the low-hanging fruit that you have, is that better supplier relationships. If you can normalize the flow of information going back towards your vendors and have them supply the materials to you when you need them, how you need them, in the form you need them, and at the cost you need them, you're going to be all the better. And obviously the ultimate goal is to have that right inventory at the right time, in the right amounts, and at the right cost.